You open your charts at 4 a.m. Your eyes are red. Your coffee is cold. You have drawn 17 trend lines on gold, marked 3 order blocks, circled a liquidity sweep in yellow, and you are absolutely certain this is the entry. Price moves the other way. It always does. You blame the pattern. You blame the algorithm. You blame the smart money that hunted your stop. But the real answer is far stranger and far simpler than anything hiding in your candlesticks. Gold was never listening to your lines. It was listening to a number you weren't even watching. That number is the yield on a 10-year United States government bond. Think about what gold actually is for a second. It is a lump of yellow metal that pays you nothing. No dividend. No coupon. No interest. You can hold an ounce of it for 50 years, and it will hand you back exactly zero income the entire time. So why hold it at all? Every asset in the world is competing for the same pool of money, and every dollar sitting in gold is a dollar not sitting in something that pays interest. That is the opportunity cost. And the moment interest rates change, that cost changes with it. When bond yields climb, holding gold becomes more expensive in a way you never see on a chart. You are giving up more and more guaranteed income just to sit in a metal that gives you nothing back. So money drains out of gold and into bonds. When yields fall, the opposite happens. Gold suddenly looks cheap to hold because you are not sacrificing much by owning it. Money floods back in. This is not a theory drawn in hindsight. In 2013, economists Claude Erb and Campbell Harvey published a study that traders still argue about today called the Golden Dilemma. They tracked gold against real interest rates, not the sticker rate on a bond, but the rate after inflation eats into it, across decades of data. Their finding was almost uncomfortable in its simplicity. Real yields explained far more of gold's long-term price than inflation fears, than currency panics, than almost anything else traders obsess over. Real yields go down, gold tends to go up. Real yields go up, gold tends to go down. Not always in a straight line. Not every single day, but as the dominant current underneath the surface. You already knew gold and the dollar move in a kind of tug-of-war. Most traders know that much. What almost nobody tells you is that the dollar and gold are both just downstream of the same source. Yields move first. The dollar reacts. Gold reacts. Your chart pattern shows up last, like a shadow arriving after the object that cast it. So, where did trend lines and order blocks even come from? Why does an entire generation of traders believe price action alone can predict a market this size? Go back to a trading floor in Chicago in the 1980s. Before your smart money concepts, before your inner circle trader courses, before any of it, there were men standing in a pit, physically shouting numbers at each other. But here is the detail almost nobody tells you. The gold pit and the bond pit were often within earshot of each other. A floor trader in gold didn't need a website. He needed his ears. When the bond pit erupted, when yields spiked on a surprise inflation report, the noise itself was the signal. Gold traders reacted to the sound of another market before a screen ever caught up. They were not reading candles. They were reading yields in real time through the oldest interface humans have. Another human's panic. That is the piece of history your favorite strategy quietly deletes. The smart money wasn't smart because it drew better lines. It was smart because it sat one room away from the actual engine driving the price. You don't have a trading pit next door anymore. But you do have a yield chart sitting untouched in a tab you never open. Here is where it gets stranger still, and this is the part your brain resists the hardest. Even when traders are shown this relationship directly, most of them still go back to drawing lines. Why would anyone ignore a mechanism this consistent in favor of shapes on a candlestick chart? Psychologist Daniel Kahneman, working with his research partner Amos Tversky, spent years studying exactly this kind of decision-making under uncertainty. Their research on what they called prospect theory showed something unsettling about how humans process risk. People do not evaluate outcomes rationally. They evaluate them relative to a story they have already told themselves, and they will keep chasing a pattern that once worked, even after the evidence turns against it, because losing that story feels worse than losing the money. A trend line is a story. It is clean. It is visual. It gives you a reason to feel in control at 4 a.m. with cold coffee and red eyes. A 10-year yield curve gives you no such comfort. It is abstract. It moves for reasons buried in central bank statements and inflation data and auction results you would have to actually study. Your brain would rather have the comforting lie of a triangle pattern than the correct, boring truth of a bond auction. That is not a flaw unique to you. It is a flaw built into how humans weigh a clear narrative against a correct one. Consider what that means for every strategy promising you an edge purely from price. Smart money concepts, order blocks, liquidity sweeps. Every one of these frameworks studies the footprint left behind after institutions already moved. None of them study the reason those institutions moved in the first place. Economist Milton Friedman spent much of his career arguing that markets are, in the end, monetary phenomena, that the price of nearly everything eventually bends to the cost and availability of money itself. Gold, an asset with no yield of its own, is one of the purest tests of that idea available to any trader alive today. It has almost nothing else driving it except the cost of money. So when the Federal Reserve signals higher rates, you are not just watching a headline. You are watching the opportunity cost of gold rise in real time before a single candle reflects it. When yields fall, gold does not wait for permission from your indicator to start climbing. Does this mean price action is worthless? No. Timing and entry still matters. Structure still matters. But price action without yield context is a passenger reading a map with no idea which direction the car is actually driving. You have been trying to predict a shadow by studying the shadow itself, never once turning around to look at the light source that casts it. Look at what happens on the days gold makes its biggest moves. Pull them up. You will find, again and again, that they cluster around interest rate decisions, inflation prints, and yield curve shifts, not around some elegant Fibonacci retracement quietly completing itself in a vacuum. The traders who consistently profit from gold are not the ones with the most colorful chart. They are the ones who treat the 10-year yield as the actual heartbeat of the market and price action as the pulse you can feel on the surface. You need the pulse to time your entry, but the heartbeat tells you whether the patient is even alive. This is not about abandoning everything you have learned. It is about putting it in the right order. Yields first. Dollar strength second. Price structure last as confirmation, not as prophecy. Ask yourself honestly how many hours you have spent memorizing pattern names compared to how many hours you have spent reading a single Federal Reserve statement. The traders on that old Chicago floor did not win because they were smarter than you. They won because they were standing closer to the source. You are standing just as close right now. Every yield chart in the world is one tab away, updated the same second the number moves. The only distance left is the one inside your own habits. You still open your charts at 4 a.m. But now, before you draw a single line, you check the number nobody taught you to watch. And gold, which was never really speaking in candlesticks at all, finally starts to make sense, not because it changed, but because you finally started listening to the right room.